Okay, well, Ed Yardeni is with us, President at Yardeni Research. Ed, good morning. Great to have you with us here as always. Thank you for your time. Prashant this side. I mean, of course, there is the local state election, which is providing a big boost. But I want to start with what's your take on Mr. Scott Bessent, the Trump's nominee for Treasury Secretary. Dollar is down 0.5% this morning.
Well, I think that's not a reaction to Bessent. I think there's a perception that he's a solid citizen, that he's certainly knows a lot about markets. And when you're at the Treasury Department, it's, I think, extremely important that the person in charge has a lot of experience in the capital markets. So I think we're in good hands. I think he'll be relatively conservative compared to perhaps some of the policy initiatives that Trump would like to propose, but he's obviously going to go along with the program. And so odds are that he will, pursue the tariff increases that Trump is proposing. But all in all, I don't think the dollar's down because he was appointed. I just think, we've had a heck of a move in the dollar, and it's easing off a bit. That's all.
So 107 on the dollar index, you think? Because last time as well, we came around these levels and then the dollar, we had a bit of a pullback. So this is it? Or so majority of the Trump thing is priced in the dollar?
No, I think the dollar remains strong. I mean, the reality is the European economies remain awfully weak. We saw that in the recent purchasing managers indexes. I'm not convinced that the stimulus programs that China has implemented do much to lift their economy. Maybe it'll kind of provide a floor, but I don't think you're going to see the economy doing much better, simply because their property market is still in distress. But again, maybe it just doesn't get worse, but I don't think it gets a lot better. And meanwhile, I think the Fed is going to increasingly signal that they're not going to be lowering interest rates anytime soon, that they may very well pause in December and into January and into March. And the reason for that is the economy is doing extremely well. Inflation is moderating still. And at the same time, the Fed has to start incorporating the likelihood for fiscal policy. And under Trump, we could have some inflationary pressures from higher tariffs. Under Trump, we could have some inflationary pressures from a stronger economy. So the Fed has to concede that and reflect that in its monetary policy.
Hi, Mr. Yardeni. Good to have you on. So if those concerns are going to play out, which means that the Fed is not going to be as charitable as we previously thought, for the reasons that you mentioned, then is the equity markets optimism well placed? I mean, equity markets are getting into, December Santa Claus mode already, whereas other asset classes like gold, like oil for that matter, are showing greater concern with respect to geopolitics, and other such situations. What do you think? Is the equity market rally going to be intact?
I think the fact that so many assets are in fact rallying suggests that we're getting into sort of a melt-up mode, rally mode that's partly Santa Claus and partly 1999 all over again. So I think that the valuation multiples in the stock market are stretched, but the U.S. economy is doing very well. The Fed really doesn't have to lower interest rates here because of the resilience of the economy. Earnings are going to continue to be surprisingly strong. And so I think we could have an earnings-led melt-up, which really isn't a melt-up. Usually a melt-up is followed by a meltdown. But if earnings are going to be pushing the market higher, that's fine. But I am a little bit uneasy that so many asset classes are going vertical here. That suggests that there may be too much optimism, too much euphoria, and that there could be some reason for a correction next year. And of course, there's a lot of moving parts to Trump 2.0, and we don't know how they're all going to interact. It's like a patient taking some medicine and it seems to work, and then all of a sudden they're taking another kind of medicine and it seems to work, and before you know it, they interact in a way that nobody expected. So that's some of the concerns I have about 2025.
Unexpected from President Trump, so we'll stay tuned to that. But Ed, the Indian markets have relatively underperformed just in the recent past, the last 45 days to around 2 months or thereabouts. At current positioning, how would you rate the Indian markets? In comparison to what's going on in the United States, that Chinese stimulus hasn't really played out according to what most market watchers were awaiting. So where does India fit into the scheme of things? We've seen a bit of a correction. Our earnings have been a little bit weak. But as you have said in the past, we are a strong economy and headed up in the longer term?
Yeah, I think at the end of the day, what matters is the economy and whether the economy is growing or falling into recession. There's no reason to believe that India is falling into recession or anywhere near a recession. Same goes for the United States. China, it's a little less certain. I mean, I think in some ways they are in a recession, and maybe all they're doing is stabilizing the situation. As I said, just kind of making a bump in their economy, but I don't see a lot of upside anytime soon. So I think when global investors look at the fundamentals look good in the U.S. They look very good in India as well, not so good in Europe, and uncertain in China. So you put it all together, and I think what you just saw in India was a correction. I think the election results suggesting political stability and more certainty about where macroeconomic policy is going to go is obviously a positive for the Indian market.
Okay, and yes, we are expecting the Indian market to react to that big win of the NDA. Let's see what the verdict is. Thank you very much for joining us this morning and and giving us those insights.